You work hard for your money. But what if I told you that the government might be taking more of it than necessary, simply because you never learned the rules? You see, most Americans leave thousands of dollars on the table every single year, just because they don't understand the power of tax planning. Not tax filing, not tax evasion, but planning. And once you get the hang of it, even if you're just starting with a regular 9 to 5, you could legally keep way more of your money. So stay with me, because in a few moments, I'll share one specific tax move that's so overlooked, yet it can instantly reduce your taxes, and most people never use it. Number 1. Know the difference between tax filing and tax planning. Filing taxes is what everyone does once a year. It's reactive. Tax planning is what the wealthy do all year long. It's proactive. Planning means you make decisions before the year ends to reduce how much you'll owe when April rolls around. Example: imagine waiting until the end of the year to realize you could have contributed to a retirement account, written off business expenses, or qualified for a tax credit. Too late. Now, right? Tax planning says, let's make those moves before December 31st. Number 2. Use retirement accounts like a legal tax shelter. Contributing to retirement accounts is one of the most basic but powerful ways to lower your tax bill. When you put money into a traditional IRA or a 401k, that income isn't taxed right now. So if you earn $50,000 and contribute $5,000 to your 401k, the IRS only taxes you on $45,000. That's less taxable income today, and your investments grow tax deferred. Let's say you're in the 22% tax bracket. $5,000 contributed could save you about $1,100 in taxes this year. It's like buying yourself a discount with your own money. Number 3. Take advantage of health savings accounts, HSAs. HSAs are one of the most tax-advantaged tools available. But here's the kicker. Most people have no idea how powerful they are. With an HSA, you get a triple tax benefit. You put in pre-tax dollars, your money grows tax-free. And when you spend it on qualified medical expenses, it's also tax-free. Let that sink in. For example, if you put $3,000 into your HSA this year, and you later use that for medical bills, it's like using tax-free money to pay for stuff you'd probably pay for anyway. And if you don't use it this year, no worries. The money rolls over and keeps growing. Number 4. Understand how tax brackets actually work. People panic when they hear they're in a higher tax bracket. But here's the truth. Only the income in that bracket is taxed at the higher rate, not all your income. So if you move from the 22% bracket to the 24% bracket, only the portion of your income above the threshold gets taxed more, not everything. Knowing this can help you make better financial decisions without fear. Example: let's say you're offered a raise. Some people turn it down thinking it'll hurt them in taxes. It won't. You'll still take home more money. Don't let fear steal your earnings. Number 5. Keep great records. The IRS loves receipts. A tax deduction is only helpful if you can prove it, whether you're a freelancer, side hustler, or just someone with a bunch of work expenses. Keep every receipt. Use an app. Use a folder. Just don't lose them. Let's say you drive for DoorDash or Instacart. Every mile, every oil change, every snack you bring for long shifts, those may be deductible. If you made $15,000 on a side gig but had $4,000 in legit expenses, you only pay tax on $11,000, but only if you kept proof. Number 6. Shift income to family members. Yes, legally. This one's sneaky smart and totally legal. If you run a business, even a small one, and your kids help, like editing videos, organizing products, managing spreadsheets, you might be able to pay them. Why does this matter? Because you're shifting income from your higher tax bracket to their lower or even zero tax bracket. For example, if you pay your child $10,000 through your business and they're under the threshold for paying federal taxes, you just saved money and taught your kid responsibility. Win-win. Number 7. Use tax credits. They're better than deductions. Tax deductions reduce your taxable income. Tax credits reduce your actual tax bill, dollar for dollar. Let's say you owe $2,000 in taxes. If you get a $1,000 tax deduction, maybe your tax bill drops to $1,800. But if you get a $1,000 tax credit, your bill drops straight to $1,000. Examples of tax credits include child tax credit. American Opportunity Credit for college students. Earned income tax credit for lower-income families. Never overlook credits. They're golden. Number 8. Harvest your investment losses. This sounds fancy, but it's pretty simple. If you sold a stock or crypto at a loss this year, you might be able to use that loss to offset your taxable gains, or even reduce your regular income taxes. It's called tax loss harvesting. Let's say you made $3,000 from a stock, but lost $2,000 on another. Instead of paying taxes on the full $3,000 gain, you'd only be taxed on $1,000. You can even use up to $3,000 of losses to reduce ordinary income each year if you have no gains. Just be aware of the wash sale rule. You can't buy back the same investment too quickly, or it won't count. Number 9. Don't overpay. Through your paycheck, you might think getting a big refund every April is a good thing, but it's not. It means you gave the government an interest-free loan all year. Instead, adjust your W-4 form with your employer and get more money in each paycheck. Then use that extra money to invest, pay down debt, or build an emergency fund. Let's say your refund last year was $3,000. That's $250 you could have had each month. What would that have done for your credit card balance? Number 10. Separate personal and business finances. If you do any freelancing, consulting, or side hustle work, open a separate bank account just for that income. When tax season hits, it's way easier to track what came in, what went out, and what you can deduct. Plus, having clean records might even help you qualify for small business tax benefits. For example, home office deductions, equipment purchases, phone bills, internet use. All of these might be partially deductible, but you need clean records to claim them. Number 11. Use the Augusta rule to rent your home to your business. Yes, this sounds like something only millionaires use, but even small business owners can do it. The Augusta rule lets you rent out your home for up to 14 days a year, tax-free, to your own business for legitimate meetings or events. Let's say you hold monthly planning meetings in your living room. If you document it properly, your business could pay you rent for that. So if fair rental value is $500 per meeting, you just gave yourself $7,000, tax-free. The business deducts it. You don't report it. Totally legal. Just follow the rules. Number 12. Invest in tax-efficient ways. Not all investments are taxed the same. Short-term capital gains on things you sell within a year are taxed like regular income, but long-term gains held over a year usually have lower tax rates, 0%, 15%, or 20%, depending on your income. If you hold for over a year, you pay less. And if your income is under a certain level, you might pay zero tax on those gains. Example, a married couple earning under about $89,000 in 2025 could pay zero capital gains tax on long-term holdings. Now that's a tax move worth planning for. Number 13. Consider a Roth IRA for future tax-free growth. Unlike a traditional IRA, a Roth IRA does not give you a tax break now, but it allows your money to grow tax-free and be withdrawn tax-free in retirement. That means if you put in $600 today and it grows to $100,000 by retirement, you pay zero taxes on that money when you take it out. It's like planting a seed today and never having to share the harvest. This is especially helpful if you think your taxes will be higher in the future. And for beginners, Roth IRAs offer flexibility too. You can withdraw your contributions, not earnings, anytime, tax and penalty-free. Number 14. Bunch your charitable donations. If you give to charity, consider bunching multiple years of donations into one tax year. Why? Because you need to itemize your deductions for charitable giving to count. If your itemized deductions aren't higher than the standard deduction, you get no extra tax benefit. But by donating 2 or 3 years' worth in 1 year, you might push your deductions over the threshold. For example, instead of donating $2,000 each year, donate $6,000 this year and skip the next 2. That can make a real tax difference. Number 15. Claim home office deductions. But be careful. If you work from home for your own business, you might qualify for a home office deduction, but the space must be used regularly and exclusively for business. This means your home office can't double as your bedroom or your kids' playroom. Let's say you have a 10 by 10 room used only for your online coaching business. You can deduct a portion of your rent, utilities, and internet based on the size of your workspace. There's also a simplified method. Deduct $5 per square foot, up to 300 square feet. Just document everything clearly. Number 16. Use flexible spending accounts, FSAs. FSAs are offered through many employers and allow you to use pre-tax dollars for medical and dependent care expenses. Let's say you know you'll spend $2,500 on medical costs this year. By using an FSA, you avoid paying taxes on that income. That could save you hundreds of dollars. Just be aware, FSAs are use it or lose it in most cases, so plan carefully. Some employers offer a grace period or allow a small rollover, but the rules vary. Check with your HR department and don't let that money expire. Number 17. Deduct student loan interest. If you're paying off student loans, you might be able to deduct up to $2,500 in interest each year. And you don't even need to itemize to take this deduction. It's available directly on the front of your tax return. Let's say you paid $1,500 in interest this year. That amount could reduce your taxable income and save you real money. But this deduction phases out at higher income levels, so check the current thresholds. Still, it's one of the easiest ways to get a tax break for paying off debt. Number 18. Be smart with capital gains timing. If you're planning to sell an investment that's gained value, think about when you do it. Selling in a year when your income is lower could mean a lower tax rate on your gains. And holding the investment for more than 1 year changes the tax rate entirely, from ordinary income to long-term capital gains. Example, if you got laid off this year and your income is lower than usual, that might be the ideal time to sell appreciated investments with minimal tax consequences. Timing can be everything when it comes to taxes. Number 19. Use education credits to reduce taxes. If you or your child is in college, don't miss out on education-related tax breaks. The American Opportunity Credit offers up to $2,500 per eligible student per year. The Lifetime Learning Credit gives you up to $2,000 per return. These credits directly reduce your tax bill and can make education far more affordable. For example, if you paid $4,000 in tuition, you could claim a $2,500 credit, effectively cutting that cost down to $1,500. And yes, even part-time students may qualify. Number 20. Take advantage of the Saver's Credit. If you're a low to moderate income earner and you contribute to a retirement account like a 401k or IRA, you might qualify for the Saver's Credit. This credit can be up to $1,000 for individuals or $2,000 for married couples. It's literally free money just for saving money. Let's say you earn $30,000 and contribute $2,000 to your IRA, depending on your tax filing status. You might get back a $1,000 credit. That's on top of your regular deduction for the IRA contribution. Number 21. Understand the standard deduction versus itemizing. Every taxpayer gets a standard deduction. For 2025, it's over $14,000 for individuals and over $29,000 for married couples filing jointly. If your itemized deductions, mortgage interest, charitable giving, property taxes, etc., don't add up to more than that, stick with the standard deduction. But if they do, itemizing could save you more. Understanding this helps you plan whether it's worth prepaying certain bills, donating more, or grouping deductions to maximize savings. Don't just let your tax software decide for you. Do the math. Number 22. Track mileage if you use your car for work. If you drive your personal car for business and you're self-employed or side hustling, you can deduct your mileage. In 2025, the IRS standard mileage rate is around 65 cents per mile. So if you drive 1,000 miles for business, that's a $650 deduction. Use an app to track your trips. Write down the date, purpose, and distance. It adds up quickly, especially for gig workers, real estate agents, delivery drivers, and even tutors. Just don't claim personal trips. That's a red flag. So, what was that overlooked strategy one promised you? It's this: start tracking your taxes like a business tracks profits. Businesses do monthly check-ins. So should you, because if you wait until March or April, it's too late. But if every month you say, "What can I do this month to lower my tax bill?" You're already thinking like the wealthy. You don't need a six-figure salary to benefit from tax planning. You just need to be intentional. What's one tax planning strategy you learned today that you wish you knew sooner? Let me know in the comments. I'm curious to see what surprises you the most.